Good morning. We'll go ahead and get started. This is Mahesh Odhrani with Strategic Wealth Design. Thank you, everyone, for joining the meeting this morning, continuing on with our financial wellness series. Today, we're talking about investing in retirement accounts. Exciting topic. So a couple of housekeeping items. This meeting is being recorded, and the recording will be made available in a few weeks once the recording passes through the compliance process. So that will be made available. The next is there should be a question box or chat box that shows up on your end. If you have any specific questions about what I'm discussing, please go ahead and throw it in the question box. If I do miss it while I'm going through the presentation, I will make sure I go through all the questions at the tail end and answer those questions as well. The next item is the handout. So all of you should have received a handout as well via email yesterday. If you did not receive the handout, please do shoot me a quick email. Let us know that you have not received it. I will make sure that you receive it after the meeting is done. But also the handout is in the handouts box that should show up on your meeting window as well. And you can download the PDF file from the handout box. So we always recommend have it printed. But if you've not had a chance to print it, but at least just follow along, and you can take notes after the fact as well. So let's go ahead and get started. Again, this is Mahesh Odhrani with Strategic Wealth Design. Thank you. I do see several clients, and we manage a lot of 401k plans as well, and I'm seeing quite a few participants from different 401k plans attending as well. So thank you for joining us. Today we're talking about retirement plans and investing in retirement accounts. This is our agenda. So we'll talk about the types of retirement accounts, the employer-sponsored plans like the 401ks or 403b plans. We'll talk about investing into individual retirement accounts and how they work. We'll talk about taxation of the different accounts that exist, and then prioritizing your retirement contributions. And lastly, we'll talk about investing mistakes to avoid. So let's kick off with the most common type of employer retirement plan that we're all aware of is 401k plans. So 401k plans are generally offered by for-profit businesses and for-profit organizations, and businesses offering 401k plans allow for pre-tax contributions. That is the most common. I'm going to talk about the post-tax, which is Roth 401ks as well in a little bit, but most 401k plans definitely offer the pre-tax contribution. And any money that you put into the 401k plan on the pre-tax basis, when you do pull it out, you pay taxes on that money when you do pull it out. So there's no taxes on money going into the 401k plan, but the taxes are paid at the time you pull it out. The benefit of the 401k plans and accessing 401k plans, if your employer offers one, they may offer a matching program. Many employers do when they set up a 401k plan. There's some form of matching program set up for the employees to encourage participation in the plan, and also for employees, give them the ability to save more for their own retirement. So not all businesses offer 401k plans. Many businesses do. If your employer does not offer a 401k plan, we will talk about the individual accounts that you can access as well. So talking about the match, in your workbook, if you have that open, there's a section in there, I'll pause for a moment, is for you to put in the match that your employer offers for your 401k plan. If you're not aware of the match that the employer is offering for the 401k plan, I would highly, highly recommend that you either take a look at some of the documents that the 401k plan offers, what they call the summary plan description. The matching should be listed in that. If it's not listed in there, or if you're not able to easily read through that document, I would suggest just talking to HR and then asking them what is the matching program set up for the 401k plan. We'll talk a little bit about taking advantage of the matching programs. One of the recommendations I always suggest is at least make your contributions or fund your 401k plans up to the matching program, because you're leaving money on the table. The employer has these programs set up specifically for their employees, and they're incentivizing you to participate in the plan to save for your own retirement. And if you're not participating, or you're not at least maximizing your contributions up to the matching program, then you're literally leaving money on the table that could be saved for your retirement as well. Moving on, we'll talk about the reasons to withdraw money. So when it comes to 401k plans, there's five ways you can pull money out of 401k plans. The first one is upon termination of employment. When you terminate employment, you generally have a few options available. You can cash out the 401k plan. If you cash it out, you're subject to taxes and maybe penalties if you're below the age of 59 and a half. If you can roll the money into an individual retirement account, an IRA, if you'd like. You can also leave the money in the plan if your account balance is over certain thresholds. Every plan is a little different. Some 401k plans allow for you to keep the money in the plan if your account balance is over a certain threshold. And threshold is usually around $5,000. So if you have over $5,000, you can leave that money in that 401k plan with your previous employer. And the last, so be able to cash it out and pay the taxes, leave it with the employer, roll it into an IRA. And the last option is to roll into your new employer's 401k plan. Most 401k plans do allow for what they call incoming rollovers. So you can roll your accounts from the 401k plan from your previous employer's 401k plan to your new employer's 401k plan. So one of the reasons to withdraw is termination of employment, and those are some options available. The other options are upon disability or death. So if you were to pass away, or if you were disabled, you can withdraw funds from your retirement account. And most of those times, it may avoid the 10% penalty if you qualify. The other options are retirement. When you do retire, you can pull funds out. And lastly, if you reach age 59 and a half, again, if you look at the 401k plan rules, some plans allow for withdrawals at 59 and a half while you're still working there. Some delayed even further to age 62 or even 65. So you really have to pay attention to the rules of your 401k plan, and if you're over the age of 59 and a half, if you can withdraw, and what does that look like? And that applies, again, while you're still working with the company. So I mentioned the Roth 401k option. The Roth 401k option now has become very popular over the last several years. Senator Roth, many years ago, I want to say probably about 15 years ago, maybe 20 years ago now, maybe even longer than that, came up with, that's where the name came from, came up with this option where you can put money into a Roth account. Roth IRAs is what used to exist before, and they still do exist. But Roth, you can put money into this sort of after tax. You've already paid your taxes. All the money that goes into this Roth bucket would grow tax deferred. You don't have to pay taxes as the money is growing in there. And then when you pull it out, it all comes out tax free. So Congress allowed for 401k plans to also offer that Roth option. So the Roth 401k options are available. We're seeing it's becoming more and more common. It's actually unusual if you don't have a Roth 401k option available in your 401k plan. So we always, especially when we're setting up 401k plans, we just recommend it's an option to add on to a plan, and employees are taking more and more employees are taking advantage of that option now. So again, for businesses, 401ks are for-profit businesses, and we'll talk about 403bs in a little bit. But the Roth option is after-tax contributions, and qualified distributions are free from income tax. And I'll talk about what is a qualified distribution. But when you pull money out, these qualified distributions upon retirement, all of it comes out income tax-free. Now, matching, the way the matching generally works with most plans is it is also matched. So if you have a matching program, generally it doesn't matter which option you pick, either the pre-tax or the Roth 401k. They are, if you have a matching program, wherever you pick your option, the matching program will still apply and the employer would match your contributions. However, if you pick the Roth 401k option, generally, the majority of the time, this is almost like 99% of the times I've yet to see the matching program go into a Roth 401k option. The matching program generally is pre-tax. So any funds that the employer is putting in is going to go into your pre-tax bucket. So essentially, when you get to retirement, what may happen if you've been funding the Roth account for a while, what may happen is you will have that Roth bucket that will come out tax-free, but you may also have this match, this pre-tax bucket where the employer has been funding over the years that would all be taxable when you pull it out. So with the Roth 401k, it's important to recognize how the matching program is going to work, and which option should you pick? I get that question a lot of times. Hey, should I do pre-tax? Should I do Roth? It depends upon your individual situation and what you feel and what you think you're going to be, which tax bracket you're going to be in retirement. So if you feel you're going to be in a high tax bracket in retirement, then the Roth 401k could be a good option. So again, that's dependent upon the individual situation. So on the Roth 401k, one more comment around the Roth or the pre-tax 401k. So you can. The other question that I always get is, can I fund both? Yes, generally, most 401k plans allow for you to fund both. So let's say you're funding 6% of your pay into your 401k plan. You can pick 3% going into your pre-tax bucket. You can pick 3% going into your Roth, or let's say 2% going into pre-tax and 4% into Roth. Yes, most 401k plans allow for that. And again, because 401k plans are slightly different, they're dependent upon how your employer has set those up. So I would recommend that you go back to your employer, read through the summary plan description, or speak to your HR and ask them, can you do both or not? Okay, talking about qualified distributions. We talked about qualified distributions are income tax free. So here are the requirements. The first requirement is there's a 5-year waiting period from when you start funding the Roth 401ks. So you have to wait the 5 years, and one of these followings have to apply. So you have to be at least age 59 and a half. You have either to become disabled or death can allow for distributions to come out from Roth being completely income tax free. So that's the requirement for qualified distribution. The funding, before we move on to the next 403B, the funding amounts in a 401k plan. So for 2020, you can fund as much as $19,500 into a 401k plan if you're below the age of 50. If you're over the age of 50, you also get a catch-up provision. The catch-up provision is another $6,500. So essentially, you can fund $26,000 into your 401k plan if you're over the age of 50. So those are the amounts as far as how much you can fund. I'm going to pause for a quick second and see if there's any questions that are popping up. Okay, so the question is, if the employer offers a 401k plan but does not offer a match, should the employee still contribute to the 401k plan, which the company controls that investment or contribute into a Roth IRA with the employee's financial advisor? So thank you for that question. I can't see yet who asked that question, but thank you. So the question is, if the employer offers a 401k plan but does not offer a match, and we'll talk about individual retirement accounts in a little bit. The question was, should you still fund an your employer retirement account versus, let's say, just a traditional IRA account? There are certain pros and cons you have to be aware of. So one is your employer retirement account. If it's a big employer and there's a lot of money in the plan, and sometimes you may not know how much money is actually in the plan when it comes to like looking at all the employees. When there's a lot of money in the plan fees are probably going to be lower in your 401k plan than what you may be able to get through an individual retirement account. So that's one thing, is to focus on the fees part of it, that the 401k plan fees may be lower than the individual retirement account that you may set up through just an advisor. The second thing to look at is the pros and cons of the investment options. So IRAs, being individual retirement accounts available through advisors, banks, and institutions, generally allow for more flexibility on investment options. So again, you have to gauge what we'll talk about investments in this presentation as well, but you have to gauge for your preference and what type of investments you like. And if you already have an advisor that you work with, that may be a good option. And then the investment options inside the 401k plans generally are limited to what you have available through the employer. So the employer has to vet through the investment options. They are supposed to be good quality investment options based upon whatever their criteria is to evaluate options. So you could have good quality investments inside the 401k plan, but you may not have that professional management when you have an advisor overseeing it. So those are some of the pros and cons. The other thing to look for, we'll talk about IRAs here, is a deductibility. So there is a rule in the IRS that under certain parameters, if you have access to a 401k plan and you want to fund a pre-tax IRA account, your tax deduction may be limited. So the factor is how much it's based upon if you have access to a 401k plan, but it's also based upon your income or your household income. So that's something your accountant generally can run some calculations on their end, the tax software, and just to be able to see if you fund the IRA, will you get that tax deduction or not? So that's again to keep an eye out for from that standpoint. The other pros and cons to talk about that is the amount of how much money you can fund. In a 401k plan, you can fund as much as $19,500 if you're below the age of 50, or $26,000 total with that catch-up provision that we just talked about. IRAs are limited. IRAs, you'll look at the numbers here, they're limited to $6,000, and if you're over the age of 50, you get another $1,000 of catch-up. So it's a total of $7,000. So again, depends upon how much you want to save. IRAs just may not give you that access to save enough. So again, I just talked about a lot of different scenarios and moving parts around it. Again, just feel free to give our office a call. We can talk about your specific situation and take a look and see how this would apply to you. So thank you for that question. I'm going to move on to the next slide. 403b plans. So 403b plans are offered through nonprofit organizations, and they're usually nonprofits, some government organizations, as well as public schools and certain ministries will offer 403b plans. In today's day and age, they pretty much walk and talk like a 401k plan. So a lot of the provisions are very similar, but only nonprofit organizations are qualified to offer it. Like a for-profit business can't offer a 403b plan. There are some nuances on the back end testing and some of the things that they look at for 403b plans. But from a participant standpoint, if you're participating in a 403b plan or you're working for a nonprofit and they offer one, it would feel everything like a 401k plan. The limits are the same, the 19.5 plus the catch up. They are also offering Roth options as well. So there's Roth 403b options too available. They pretty much walk and talk like a 401k plan. And from a participant standpoint, you're really not going to see a whole lot of difference. On the administration side, from an employer standpoint, 403b plans, depending upon a few things, could be a little bit easier to administer from an employer standpoint. So the next type of plans we'll talk about is 457 plans. 457 plans generally available to governmental employees. They're called tax-deferred plans, non-qualified deferred compensation plans is another term for that. There's a few different types of 457 plans. They walk and talk like a 401k plan, may feel very similar if your employer offers them. Sometimes the investment options are all going to be the same to your 403b plan or even your 457 plan, your 401k plans. They offer pre-tax salary reduction. And so 457 plans are only pre-tax. So it offers pre-tax salary reduction, and the growth is all tax deferred until you pull the money out. Unlike 401k or 403b plans, the benefit of 457 plans is that when you want to pull the money out, when you leave the employer upon termination or upon retirement, you can pull money out without that 10% penalty if you're below that age of 59 and a half. So that's a benefit of 457 plans, is that 10% penalty is avoided if you were below the age of 59 and a half. So again, they walk and talk like 401k and 403b plans from your perspective, from a participant's perspective. So, but these are tools available as well to government employees, and certain nonprofits offer it as well. Next, we're going to pivot a little bit to small business plans. So we're going to talk about individual 401ks, SEP, simplified employee pension plans, saving incentive match plan for employees, what they call the simple plan, and we'll just cover them at a high level. So individual 401ks, or what they call solo 401ks, or employer-only 401ks, they're very popularly known as solo 401ks. They're available for business owners. They're just by themselves. They don't have any employees. Once they have employees, then certain other rules have to apply. But solo 401ks, when you don't have employees, you're a business owner, you can fund up to the 401k maximums. There's additional matching can be made through the business, as well as what they call profit sharing contributions. So it could be a very powerful tax deferral tool for individuals that are sort of on their own and don't really have any employees. Simplified employee pension plan, a SEP plan. It's called a SEP IRA. Some of you may have heard that term, SEP IRA, which is Simplified Employee Pension Plan. And again, this one is sponsored by the business. We have seen it where some businesses have offered it when they've had employees, but generally works best when again we have one single sole business owner, no employees in the business. In that scenario, if they start hiring employees and they had a SEP, generally what ends up happening is most of those individuals end up moving into a 401k plan after once they start hiring employees. So, but a SEP works phenomenal for again single owner, no employees businesses. We have saving incentive match plan for employees, simple. Some of you may have come across this, may have been employed by an employer that offers this. This is a good tool again for offering it for to employees, and it usually requires a matching program from the employer as well. And it could be similar in the sense where the employer can provide a platform and investment options, but these accounts generally are also individually controlled in the sense that they're called simple IRAs. So employees can have their own accounts with their own respective advisors, and the employer can even so the employee funds the account with their own deferrals or deductions from their own paycheck, but also the matching is made by the employer also. So some of you may have come across, but these are small business plans. So if any of you are a small business owner, these are some options that perhaps to consider, not only for your retirement, but if you're a small business with a few employees, a simple plan could be a good fit as well. All right, next we're going to pivot to individuals. So IRAs and individual retirement accounts. So we have two types of IRAs here in the U.S. We have the traditional IRA and the Roth IRA. And the traditional IRA can be a deductible or non-deductible. So both of these accounts, the traditional IRA or the Roth IRAs, pretty much you're putting after-tax money into those accounts. Now, what depends is, would you get a deduction on your traditional IRA or not? And Roth accounts are generally non-deductible. Like we talked about the pre-tax 401k. So traditional, if you get a deduction on that traditional IRA, and when you pull the money out at retirement, that's when it's taxable. Roth, on the other hand, just like a Roth 401k that we talked about, money goes in after tax, and then when you pull the money out at retirement, it comes out completely tax-free. So that 5-year rule still applies to the Roth IRAs as well. But it's important to understand on the pre-tax side, there's deductible versus non-deductible IRA, and there's some techniques around that as well. Now, if your employer offers a retirement plan like a 401k plan, I talked about this a few moments ago. So if an employer offers a 401k plan, you may be restricted. And I say may because IRS has some rules around that. You may be restricted in receiving a deduction if you wanted to fund a traditional IRA account. So if you still want to fund a traditional IRA account, even while you have the 401k plan, you can fund a non-deductible IRA. So you do have the ability to do that. What we always, sometimes we see this where individuals have both a deductible and non-deductible. It's just over time, they've been saving in retirement accounts and 401ks, and they've accumulated money in retirement accounts, and they have contributions that have been both deductible and non-deductible. And at retirement, the tax consequences on those are going to be slightly different. We've seen it in one account, being held in one account when it's both deductible and non-deductible, and it creates a lot of confusion for the client and even for us as advisors is to discern, okay, which one's deductible, which one was deductible and will be fully taxable, and which one was non-deductible and is only going to be partially taxable. So, so generally, if you're not qualifying for deductible IRA, we always recommend that you do a traditional IRA, you do the non-deductible IRA in a separate account, because from an accounting standpoint, a taxation standpoint, and for your accountant to run numbers and look at what's taxable and what's not taxable, it's much easier to do it if it's as two separate accounts versus those funds being commingled into one account. So that's, again, something to look at. You do have the ability, if you're not qualifying for deduction on the traditional IRA, you're maxing out your 401ks, your 403bs, you want to fund more into retirement accounts, perhaps a non-deductible IRA could be an option. The limits on IRAs is $6,000 per year or $7,000 if you're over the age of 50. So let's talk a little bit about distributions from IRAs. So generally, and it works similar to 401k plans to a certain extent. Most individuals retire from an employer, and when they retire, they are required to take distributions either out of a 401k plan or the IRA, and that age is 72, and that's called required minimum distribution, or RMD. You may see that acronym thrown around as you start getting close to your retirement age, as you start getting close to age 72. So starting age 72, IRS requires us to pull money out of the retirement accounts, and everything that comes out at distribution is fully taxable when it comes to traditional IRAs, unless you had a non-deductible IRA. At age 59 and a half, if you've turned age 59 and a half, you can pull out funds without the 10% penalty. If you're below the age of 59 and a half, then there's a 10% penalty that applies. Roth IRAs. So again, after age 59 and a half, and of course 5 years, that 5-year rule that we talked about previously, you can start pulling money out tax-free from Roth IRA accounts. There's no RMDs. There's no required minimum distributions like the traditional IRAs starting at age 72. However, upon the individual's, the owner's death, the beneficiaries must begin required minimum distributions from the Roth IRA accounts as well. So that's a part of the requirement for Roth IRA accounts. All right, I'm just going to take a quick pause here and see if there are any more questions that popped up in the chat box here. Bear with me. No more questions. Okay. So moving on. So we'll start talking about investments now. Like how should you invest your money inside these retirement accounts and in allocating your money to different investments? General rule is the younger you are, the greater ability you have to tolerate risk because you have time on your side. So the younger you are, the more time you have to retirement, so you can withstand those ups and downs of the market over time. So you have greater ability to tolerate risk. There's other factors that go in as well, and generally with most 401k plans, or you're looking at working with an advisor, you can complete something called a risk tolerance questionnaire. We have some as well. If you'd like to see what your risk tolerance looks like, feel free to send me an email. We'll send you a questionnaire too. Be able to so you can answer a few questions, but even those questionnaires are heavily weighted upon age, like how far you are from retirement. So the younger you are, the greater ability you have to tolerate risk. And to talk about the maximum benefit of the tax benefits that you receive from funding retirement accounts, either the tax deferral using a pre-tax bucket on your income, or using, for example, a Roth bucket where everything goes in post-tax but comes out tax-free at retirement. So to get the maximum benefit of tax deferral is to really take a look at the tax-deferred retirement accounts and in looking at your taxable, and then once you've maximized those, then you start taking a look at taxable investment accounts. Next after that is if you still have the capacity to save more, it would be important to first take advantage of your employer, and we'll talk a little bit about that here in a moment, your employer retirement plans, your individual retirement accounts, and then lastly going into taxable investment accounts. So other factors to consider as you're looking at, okay, how much did you put away? As a recommendation, as a general recommendation, I always say about 15 to 20% of your income should be saved across all your different saving vehicles that you may have. Does not mean you have to put 15 to 20% into your retirement accounts, which may be good because it still gives you those tax benefits. But overall savings rate should be about 15 to 20%. And the reason for that is because studies have shown that most people need 70 to 80% of their income, pre-retirement income, to maintain their lifestyle throughout retirement. So for example, if you were earning, let's say, $50,000 a year pre-retirement, then the goal would be to get you to about 80% of that, so it's about $40,000 a year of income in retirement to maintain that standard of living. So the factors that impact, there's other moving parts to that. Your desired standard of living, what's the quality of life you want in retirement, what are other expenses that may look like in your retirement. Every person's retirement is going to be different. Medical cost, so if you're pretty healthy, your medical costs are going to be lower, but if you have pre-existing medical conditions, then the medical costs may be higher in retirement as well. So those have to be factored in. And then the target retirement age, when you're going to retire, and then one of the things that's not listed on the slide is life expectancy. What does your life expectancy look like given your family history? Because we have to factor that in as to how long will you live, and that's one of the things that we can't predict, but based upon some family history and some tools available out there, depending upon how your health is, for a group of individuals, we can say, okay, you know what, expected probability is you're going to live till age 85 or age 90 or 95. So we have to look at some probabilities and test to see if your retirement income, this income, that the 80% of your income to maintain a standard of living, will sustain that based upon the number of assets that you built up in your retirement accounts. So it becomes critical to look at those things because inflation is going to impact your retirement income as well. And we'll talk about one thing that I always mention. It's not about how much you have in your retirement accounts. It's about what income that will generate. So more and more conversations today are about, yes, you need to fund the retirement accounts, and that's going to grow over time. But your funding goal should be based upon generating this 80% of income. So if you are younger, the sooner you start, the better it is because you have more time on your side, and you may only need to save, let's say, 10% of your income to get to that 80% threshold. But if you haven't saved and you're older, you're in your 30s or 40s or even 50s, that means a larger percentage of your income may have to be saved to get to that 80% threshold. So to look at what your quality of lifestyle you want to create at retirement, looking at that income number versus saying, okay, this is how much I want to have at retirement. It's looking at, okay, what is that retirement account going to do for me what is that retirement account going to generate for income purposes at retirement? And next week's financial wellness webinar that we're going to have next Thursday, same time, same bat channel, we're going to be talking about retirement income. How do you generate retirement income, and what are some options and solutions available out there? So prioritizing your retirement contributions, again, the key is to start with your employer-sponsored plans, especially if they're matching your contributions. Again, that is money you would be leaving on the table if you do not participate, at least up to the match. And I know someone asked the questions about if there's no match or even beyond the match, should you do the employer plan or should you do the IRAs outside? We went through some of the pros and cons of which options you can, pros and cons between those options. So again, next is if you're self-employed, looking at either other employer or your spouse's employer. So if they have access to a 401k plan, leverage their 401k plan more because at the end of the day, if your spouse and you are filing joint tax returns, it impacts both your taxable income. So look for these tax deferrals, tax deductible contributions, 401ks. IRAs would be after you've sort of maximized some of those things, and then lastly is taxable accounts. So if you still have the capacity to save more, it becomes important to save more save and invest more, so that you can grow your assets and your wealth faster. But once you've exhausted these retirement programs and these tax deferral programs, then you start taking a look at investing in taxable investments. So I'm going to pivot next to talk about 7 mistakes to avoid when it comes to investments and just overall investing for your retirement. So first is not taking full advantage of the tax breaks. These programs are designed by the IRS, by Congress, over many years to give individuals certain tax breaks to save for their own retirement. One of their goals has always been is not to burden the Social Security system, not to burden the government to provide for retirement benefits for individuals. So because of that, they have provided incentives that when you fund these retirement accounts, you do get certain tax breaks. So it could be on the pre-tax basis where you get a tax deduction today, or on the Roth basis where you put everything with after tax and everything comes out tax-free. So this is one of the mistakes that we do see, is that people are not taking the full advantage of these programs to create these tax breaks, not just today, but even at retirement. The next mistake that I see is not saving enough or at all. So we've come across individuals that may only save 3, 4, 5, or 6% in their retirement accounts, and let's say through their employer, but that's just not enough. So research has shown over and over again that 10, 15, or 20% is what's going to create enough income in retirement so that you don't have to sacrifice lifestyle. So the goal is, and I always talk about saving. Saving is like a muscle. So if you're only saving 5% of your income in whatever buckets, either retirement accounts or other vehicles outside of that, if you're only saving 5% of your income, what I would recommend is stretch that muscle. Try to bump it up to 6%. Try to bump it up to 7%, 8%. Now, it's like going to the gym. If I haven't worked out for a long time, and if I was to go to the gym today, as an example, and I start running at 10 miles an hour on the treadmill, start lifting heavy weights, 1, I'm going to get burned out. 2, I'm probably going to injure myself. And that's the same thing with savings as well. If you're saving at 5%, it would be great if you can bump it up to 10 or 15% and stay there. But the burnout rate is going to be high. So try to increase it gradually. Try that 6% and see how it feels over the next few months. Then you go up to 7% or 8%. So gradually increase your savings rate, because it is like a muscle. It is a habit that needs to be built. Over time. So I always encourage that. Come across individuals that are not saving enough, and that will have an impact on their retirement in the future. Number 3 is high fees in retirement plans and investments. So fees do impact your outcomes, and take a look at, understand the fees, understand the cost of what it calls doing business, the cost of these investment programs, cost of your employer retirement plans or investments. it is important because it will impact your outcome. The last is focusing, not last, but number 4 is focusing on only one risk. Many times people are just looking at one investment in their retirement accounts and focusing on the returns, or focusing on just one type of risk. And an example would be like, for example, like stocks. Stocks have what they call market risk. So market risk can make the stocks go up and down. And someone may be scared about that, and they may invest 100% into bonds, as an example. Bonds are generally like you're loaning money to companies. That's what bonds are. You're lending money to large companies or the government if you're buying government bonds. But the bonds are also have risk with interest rates. So if interest rates fluctuate quite a bit, you're going to have risk in those bonds as well. So focusing only on one risk can make your portfolio perhaps too aggressive or too conservative. So the goal is to diversify. You've heard that term before. Diversification is key when it comes to investing. Diversification may or may not work in the short run, but studies have shown over and over again that diversification does work. It smooths out the ride over long periods of time. So your accounts are not going to go through these big swings, versus it's going to have sort of a smoother ride as you go along, because different investments have different risk and they perform differently in different environments. Next is investing aimlessly. We do a lot of 401k plans, and I do come across participants that are just, I'm just going to pick whatever investments I want, or I set my investment portfolio up like 5 years ago or 10 years ago, and I've never touched it, especially inside of employer retirement plans. When you have an advisor that you are working with on your personal accounts or individual retirement accounts, those are generally we don't see that. But when it comes to employer accounts like 401ks, 403bs, we see that happen, and unfortunately, sad to say that it happens more often than I would like to. But come across individuals that are just aimlessly picking investment options and not focusing on that goal, like we talked about, generating the retirement income. So having a certain goal as to how they want to invest and what returns they would like to generate over long periods of time, and what the impact of that is going to be to their retirement. So definitely focusing on how you invest and how you pick those investments. Number 6, again, what I talked about is retiring with no plan for income. It doesn't matter how much you save. It matters because it's going to generate income. But what doesn't matter is the account balance that you have in your 401k or your retirement accounts. What matters is, what is that going to do for you? How is that going to generate income for you at retirement? That's what matters. So we come across individuals that are getting close to retirement and just haven't created a plan for income. And so I always recommend that definitely have that, understand what your standard of living is going to look like at retirement, and create that plan for retirement income. The 7th and the final mistake is sort of that hoarding mentality. So after decades and years and decades of investing over time, people find it difficult to shift that mindset as they're going into retirement. They want to hoard on to their investment accounts, their retirement accounts, spend as little as possible, largely because they may be concerned about when they're going to run out of money if they end up living too long. So there's a balance between that and when individuals get to retirement, we'll talk a lot about this next week as well. When individuals get to retirement, we always recommend there's a balancing between enjoying the quality of life of retirement, because you've worked so hard for the last 25, 30, 35 years. Let's enjoy the wealth within certain parameters, so you don't run out of money. But that's what the purpose of these accounts. The purpose of these accounts is to generate retirement income and to provide for you in your retirement. And that hoarding mentality, unfortunately, sometimes prohibits individuals from truly enjoying their retirement and working with a professional and having sort of these parameters on what you can do and how much income you can take out may help alleviate some of that and help you enjoy retirement even more. So we're reaching the tail end of our presentation. Again, if you have any questions, go ahead and put it in the question box for anything that I discussed, and we'll take the questions here in a moment. So talking about key takeaways is first we talked about the different types of retirement accounts: 401ks, 403bs, 457 accounts. Those are like in the employer-sponsored plans. We also talked about small business plans for small business owners, the solo 401ks, the SEPs, and the simples. We talked about individual retirement accounts and what do they entail, and some of the distributions and tax consequences when you're starting to pull out from all these different accounts. And lastly, we talked about prioritizing contributions, which is employer plans with a match first, maximizing your other opportunities with your spouse's retirement accounts, and then IRAs thereafter, and then taking a look at perhaps still looking at taxable investment accounts to save more for your future. But the biggest thing, the number one thing that I always tell people is the takeaway from all these: there's a variety of different accounts and retirement plans and options and choices available. They are meaningless if you're not saving enough. So the key is to save, because at the end of the day, we have to take our ownership of our own retirement and our own future. So the key takeaway I'm hoping everyone takes from this call is to save. And if you are struggling with saving, if you are struggling with cash flow, we talked about cash flow and debt management and budgeting at our last call. So the recording will be made available. Once it's available, please watch that. There's also a workbook that goes along with that as well. But if you are struggling with that, you need a little bit more guidance and someone to walk you through the process, someone to hold you accountable. Please do feel free to reach out to us. We're more than happy to assist you with that. So I'm going to open it up for questions and actions. So in your workbooks that you received, at the tail end, there's a page for actions. So everything that you learned today, what I would suggest, if there's any actions, any thoughts that came to mind, say, hey, I want to look into this, or I want to talk to an advisor about this, or I want to call Mahesh and ask him these questions about my own 401k plan. Whatever those questions are, whatever those actions are, just go ahead and start jotting them down. Just create that to-do list for yourself on what you're going to work on. Coming on these webinars, hosting these webinars are great. They are helpful. I mean, our goal is to educate. That's what we're passionate about, is to educate everyone in our community and across the country, because we do have individuals joining us out of Nevada as well. The goal is to educate everyone, but education can only go so far. Where the rubber meets the road is where you take action. So take action, write it down on how you're going to take action, and what's your next steps going to look like in terms of these retirement accounts and how you're going to evaluate those. So with that, I'm going to open it up for questions, and I'm going to just open up my question chat box here. If you have any questions, go ahead and put them in the chat box or in the questions. So I don't see anything in the chat box. Put up the question box here. I don't have any questions in the questions box either. So that's the end of the presentation, and I'll wait here another maybe 30 seconds, see if anyone has any questions pop up. And if there's no questions, then we'll go ahead and end the call. So before I end the call, and it looks like there was just a comment. Debbie, thank you for your positive feedback. I appreciate that. Next week's call is all about generating retirement income, and that's the fourth and the final part of our financial series. Most of you should have also received an invitation for another webinar that we're hosting 2 weeks from today. Same time, same bat channel. We're going to have a guest speaker talk about some crucial tax planning strategies for 2020. So before the year ends in 2020, is to open up conversations around some tax planning ideas as well. So Dean Meoli will be our guest speaker, and he's from our investment company SCI that we work with quite a bit, and he will be guest speaking 2 weeks from today on tax planning. So that would have been a separate invitation that would have come to you as well, and that invitation in fact went out yesterday. So you should have that in your inbox as well. If you do not and you'd like to attend that, just shoot me a quick email back, and we'd be happy to resend that invitation over to you. I'm going to put my email in the chat box here. If most of you should have it, and I'll put my phone number in there as well. There we go. So again, feel free to give us a call or shoot us an email if there's any additional personal questions that you have, or you'd like some guidance on your personal situation. So with that, thank you everyone for being on the call. Really appreciate it. Have a great rest of your Thursday, and we'll talk to you again next week when we talk about retirement income planning. Take care.